All right, let's just get right into it, shall we? Welcome to today's Explainer, where we are unpacking what might be, honestly, the most highly anticipated financial report in the tech world right now, NVIDIA's Q1 FY27. We're going to decode the staggering growth, the very real geopolitical risks, and what this massive financial result actually means for the entire future of the AI market. Let's dive in.
Boom, $81.6 billion with a B. That is NVIDIA's revenue for just the first quarter of fiscal year 2027. You know, we are talking about an 85% year-over-year jump. As someone who has followed tech for a long time, it is absolutely wild to see a company of this sheer size pulling off growth numbers that look like an early-stage hyper-growth startup. The sheer undeniable scale of this success is exactly why we need to unpack how they did it, and honestly, more importantly, where they're going next. So, here is our roadmap for this explainer. First, the record-breaking quarter. Second, beyond the GPU. Third, the edge computing shift. Fourth, navigating the China risk. Fifth, the competitive landscape. And finally, we'll wrap up with the new AI economy.
Starting things off with part one, the record-breaking quarter. Let's peek under the hood of these massive numbers. The undisputed engine driving this entire valuation is the data center. Look at that massive leap right there, going from $17.6 billion in Q1 of last year all the way to $37.9 billion this quarter. Hyperscalers, so your Microsofts, Googles, Amazons, Metas, they account for about 50% of this revenue. But what's absolutely crucial to understand is that the other half, it's coming from a really diverse mix of AI clouds, enterprise, and sovereign customers. The demand for their Blackwell architecture across the board is just relentless. Now here's where it gets really interesting, how this translates to profitability. Yes, revenue is up 85% and diluted earnings per share skyrocketed 140% to $1.87. But just take a second and look at that gross margin, 75%. That's an increase of 14.2 points from last year. That level of margin on hardware is pretty much unheard of. It basically means for every dollar coming in, a massive chunk is pure profit, which was driven in part by clearing out some older excess inventory charges from last year. So what do you do when your business is generating billions in free cash flow? Well, you return it to the shareholders. NVIDIA just announced an incredible $80 billion share repurchase authorization, and that's on top of the nearly $39 billion they already had left over. They even bumped up their quarterly cash dividend from a single penny to 25 cents per share. It's a massive strategic move that highlights just how much of a cash-generating machine this whole infrastructure build-out has become. Moving right along to Section 2. Beyond the GPU, the infrastructure evolution. Now that we've seen how much money they're raking in, let's explore how they are fundamentally rewiring global computing.
The next big frontier, according to CEO Jensen Huang, is something called Agentic AI. We are basically moving past the phase of just using chatbots to help write an email or plan a weekend trip. Agentic AI is this idea of a future where billions of AI agents actually use tools, kind of like how you or I use a computer, to perform autonomous, productive work. This isn't just about generating text anymore. It's about generating real, tangible value and scaling it across global industries.
So why does Agentic AI matter so much for NVIDIA's bottom line? Because it completely flips the hardware math. In the past, massive data center configurations might run, say, 40 GPUs to just a single CPU. But to power these autonomous AI agents efficiently, that ratio is shifting dramatically, closer to 1 GPU for every 1 CPU. This is a game changer. It represents a huge new growth opportunity for NVIDIA's CPU business, showing how they're aggressively transforming from a graphics company into a total infrastructure giant.
And to capture that massive CPU and GPU market, NVIDIA is just running at a relentless pace. They're dominating right now with the Hopper generation and rapidly transitioning into Blackwell. But they aren't stopping there. Actually, scratch that, they're speeding up. The Vera Rubin architecture, which importantly features their highly anticipated Vera CPU, is on track for the second half of this year. And right after that, we already have Feynman on the horizon. It is a crazy yearly release cadence designed to offer compounding returns and basically the lowest total cost of ownership for their clients.
All right, Section 3, the edge computing shift. Because this quarter, NVIDIA actually threw analysts a bit of a curveball in how they report their financial categories.
They have fundamentally resegmented their revenue. First off, within the data center, they are now clearly breaking out hyperscale from AI clouds, industrial, and enterprise. This is a very direct signal to the market. It proves that all this demand isn't just coming from 3 or 4 megatech cloud providers. The demand is broadening out into a really diverse base of end customers. But honestly, the bigger surprise was what they did with everything outside the data center.
They created this brand new bucket called edge computing.
And this segment now includes PCs, workstations, robotics, automotive, and yes, even game consoles. Basically, they are mushing their original gaming roots, the exact stuff that made them a household name decades ago, into this broader edge category. Now, sure, it's a smaller piece of the pie at about $6.4 billion right now, but it's already up 29% year over year. It's a clear sign that they view everything outside the massive server farm as one unified ecosystem for deploying AI.
Now for Section 4, navigating the China risk. Because as invincible as these financial numbers look, we've got to ground this explainer in the very real geopolitical realities facing the semiconductor industry right now.
It's the inevitable question, right? What about China? Look, there's a highly complex debate happening right now over export controls. On one side, some argue that exporting tech to China benefits the U.S. economically and creates long-term technological dependencies. On the flip side, there are incredibly strong arguments against providing top-tier, potentially military-applicable technology to a major economic rival. Now, as an explainer, our goal here isn't to pick a side in that debate. We just need to look at how this geopolitical tug-of-war is actually impacting NVIDIA's balance sheet today.
And the immediate financial reality is pretty stark. In their Q2 FY27 outlook notes, NVIDIA explicitly stated that their outlook does not assume any data center compute revenue from China, zero. Despite holding U.S. export licenses, they reported zero revenue from their older Hopper chips in China last quarter because the imports simply aren't being authorized on the receiving end. They're essentially writing it completely out of their near-term financial forecasts and adapting to the climate as it is.
Let's look at Section 5, the competitive landscape, defending the crown. Because when there's over $81 billion on the table in a single quarter, you better believe the rest of the tech world is mobilizing.
You've got companies like AMD, Cerebras, Amazon, and Google all pushing their own custom silicon. But this battlefield is really split into two main workloads. First is AI training, which is that massive, computationally heavy phase of teaching an AI model from scratch. NVIDIA completely dominates here, and analysts really don't see that changing anytime soon. But AI inference, the phase where the AI actually runs and answers your day-to-day prompts, that is a bifurcating, highly competitive market. Competitors absolutely see inference as their best shot to break NVIDIA's stranglehold.
But, NVIDIA isn't exactly sitting still. To defend their flank in that exact market, they're making aggressive strategic moves, like their acquisition of Grok. By embedding these highly specialized chips, or LPUs, into their broader ecosystem, they are fighting to ensure they always offer the absolute lowest total cost of ownership, no matter what specific workload a client is trying to run.
Finally, Section 6, the new AI economy. For this last part, let's zoom all the way out and look at the macroeconomic impact this whole boom is having on the world.
One of the most fascinating developments is the rise of what's being called sovereign AI. This isn't just about Silicon Valley tech companies anymore. Entire nations and governments are stepping up to buy massive quantities of AI chips. They want to build and secure their own domestic AI infrastructure. AI has officially transitioned from a corporate arms race to a national security priority.
And the broader private sector, they're scrambling right alongside them, because the major hyperscalers are actually facing severe power constraints and compute scarcity. They don't always have the extra capacity to just rent out to everyone. Because of that, over 5,000 regular enterprises have now gone out and purchased GPU-equipped servers to build their own on-premise infrastructure. This demand is trickling down everywhere because raw compute power is literally becoming as fundamental to business as electricity.
Bringing it all together, Jensen Huang explicitly stated that the build-out of these AI factories is the largest infrastructure expansion in human history. Let that sink in for just a moment. The sheer volume of hardware, power, real estate, and capital being deployed globally right now to support this shift, it is entirely unprecedented, and it is only accelerating.
Which leaves us with this final, provocative thought for our explainer today. Look at the $81 billion in revenue. Look at the massive shift towards CPUs for Agentic AI, the rise of sovereign AI, and the billions being spent by individual enterprises just trying to keep up. If the global build-out of these AI factories truly is the largest infrastructure expansion in human history, is NVIDIA's long-term growth actually still underappreciated by the market? It's a massive question, and it's one that's going to define the global economy for years to come. Thanks so much for joining me today to decode all this. And as always, keep learning out there.